Hi, I would like to welcome everybody to today's webinar on the $8,000 first-time homebuyer tax credits. We have a short presentation here. We've had a lot of interest from folks regarding this tax credit, and this is designed for both realtors and homebuyers together. As you will see, some housekeeping things on the upper right-hand side of your screen. There is a hand that you can raise. I do ask that you hold all questions to the end, and you may also expand the box and type questions in there. If everybody could raise a hand if you are a realtor, out of curiosity to see what our count is. Does everybody see the little hand on the right-hand side? I see we have one up. I have a few up. Okay, you can unraise your hands. Okay, thank you. So we're going to get started now. And again, I want to welcome you. My name is Paul Canner. I am with Trustmore. And we're going to talk about first-time homebuyers and the tax credit associated with them, with the first-time homebuyers. All right, so here's a little outline of what we're going to go through this evening. We're going to go through, does it still make sense for somebody to buy a house? Have that question. And then we're going to go through the basics and the time frame of the tax credit and who qualifies, how to get your money from the government. So let's go ahead and get started. So should we rent or should we own? Well, it depends on several factors. Someone's standard of living, life decisions, money. Talk about the standard of living. More home for your money. Let's take a look at this. So if you rent, here we're doing a comparison of a 2-bedroom apartment with 2 baths versus a 4-bedroom home with 2.5 baths. About almost twice the size, 1,098 square feet to 1,924 square feet. Well, you purchase a house, so you have a $200,000 investment. If you rent, you don't own anything. Monthly payment. Well, this doesn't look so good now. The rent is only $1,035 a month, while the owning is $1,321. Well, there are some tax savings for owning a home, and you get a tax deduction, and we're not going to go too deep into that, but we can, if you have any questions with that later, go through that. But you save $384 a month in this scenario. So that gives you actually showing where the rent is more expensive than owning here. And so as you can see, it's $936 versus $1,035, so it actually works out to be $99 or just shy of $100 difference. Well, right there, that makes a lot of sense. So again, more privacy. You want to live in a big building or have your own home and your own outdoors? Wider choices of neighborhoods when you own. You have choices of a single-family house, attached housing, condominiums, townhouses, so forth. Life decisions. Well, yes, money is involved. But renters and homeowners both make mortgage and property tax payments. The only difference is whether it's the landlord's or their own. This is kind of freaky here. If somebody's paying $1,500 a month in rent, which we're seeing plenty of folks doing that, and rent increases only 5% a year, which right now I think rental rates increases are a little bit higher than that. It's nearly $100,000 paid to the landlord. It's very hard to look at. Let's look at the example here. So year one, the person pay $18,000 a year in rent. Year two, another $18,900 now. Year three, the rent goes up to $1,654 a month. Year four, we've now paid another $20,000, almost $21,000 in rent. And year five, we're almost at $22,000. So here we go. We're just shy of $100,000 to the landlord. Makes you want to buy, huh? All right, so let's talk about the tax credit here. Some of the basic things behind the federal tax credit of $8,000 for first-time home buyers. If the credit is not actually $8,000, but it's 10% of the purchase price up to $8,000. So if it's an $80,000 home, then you've qualified for the full $8,000. If somebody were to purchase a $60,000 home, then it would only be a $6,000 tax credit. Typically, most of the transactions we're seeing are sales prices well above $80,000, so we would use the $8,000 tax credit. And this is a tax credit. Unlike the mortgage interest deduction, it is a straight credit. So if somebody had no tax liability, they would still get $8,000 back. So that's pretty cool, and that's one of the few tax credits out there. Unlike the first-time homebuyer tax credit that was in effect during 2007, this one does not have to be repaid in most instances, and we'll go through that in a second, but does not have to be repaid, so that's putting $8,000 in your pocket. This alone may be reason to push somebody to buy a house as opposed to renting. And again, different types of homes that are eligible: single-family detached, attached homes, mobile home, home boats, RV. As long as it's your primary residence, has a bathroom, sleeping, and kitchen facilities, and you're using it as a primary residence, it will qualify. Okay, again, only primary residence, so not if somebody's buying an investment property, that would not qualify, or a second or vacation home. And again, in most instances, the $8,000 cannot be used for down payment, and we're using a 3.5% assuming an FHA loan. It is not a requirement of this program what type of financing you get. So here we go. Who is considered a first-time home buyer? And that would be an individual or a couple or many folks who have not owned primary residence in the last 3 years. So if somebody owned a primary residence 37 months prior to closing on the new home, and they did not own a primary residence after that 37 months, they would qualify and be considered by the IRS a first-time home buyer. If, for instance, we had a borrower the other day who had inherited a property which she sold, and that was 3 months prior, that was not a primary residence. Even though that individual owned a home, it was not her primary residence, so she still qualifies for the tax credit. Now catch this out. There is an exemption here where a parent can buy the home as a cosigner on a loan, and you'd still qualify for the children would still qualify for the $8,000 tax credit. And the tax credit has some limitations on income. It starts to phase out for an individual of $75,000 and $150,000 for married couples. Now, if a wife makes $100,000 and the husband makes $35,000, they would still qualify for the full credit. Once if the individual is buying a house unmarried, the maximum amount of income would be $95,000 when there would be no credit. It would be prorated between the $75,000 and $95,000, and $170,000 for married couples. So if a married couple were to make $160,000 and they bought a $200,000 home, they would get half of the $8,000 because they're halfway between the $150,000 and $170,000 line. So we're going into the next field. That's going to be the time frame. So now, anybody who closes on a home, the primary residence, between January 1st of 2009 and November on or before November 30th of 2009, then they would qualify for this first-time home buyer tax credit. That's pretty straightforward. How do you get your cash? Well, the easiest thing is you could take a credit on your 2009 tax return. However, I like to get my money sooner. So the IRS will allow folks to file an amendment to 2008 tax return for the $8,000. So if somebody's already received the first refund or paid their taxes and they file the amended return, the IRS will send the $8,000 back to the person. Remember, this does not have to be repaid, unlike the 2007 credit.